This week, Australia's four major banks are set to deliver their six-month financial results, with a forecasted collective cash profit of $16.2 billion. This surge in profitability largely points to the rapid-fire rises in the official cash rate over the past year, driving up borrowing costs to create larger margins than ever before. And while many concede the windfall of profit won't last indefinitely, analysts believe the bank's sizable margins won't be going anywhere just yet. But despite their hefty profits, the cost of living crisis has been impacting Australians more and more, with increases in electricity bills, mortgages, and rents just a few of the many expenses that have been pushing households towards the brink. It's for this reason that the Australian government commissioned an inquiry into how these banks price their loans and deposits, aiming to ensure that consumers aren't too heavily burdened by costs. Concern from this inquiry has largely pointed to the bank's reliance on deposits for their funding, and the subsequent economic implications should price rises for deposits and loans become too drastic. For example, low borrowing rates during the pandemic may have caused many recent buyers to stretch themselves too thin, leading them to expenses over 30% of their before-tax income on mortgage repayments or, in some cases, as much as 40%. It's clear to see, then, that while the banks are seeing record or near-record levels of profits, they remain subject to the limits and risks of their markets. And while the level of bad debts and business failures is still modest, if conditions were to deteriorate dramatically, it could cause major financial pressure on the institution should those defaults arise. As the banks move forward in their operations, then, one thing remains certain: maintaining a balance between risk and reward must remain their priority for continued success.